Most investors hear people throw around the terms hard money, DSCR, and bridge loans like they're interchangeable. They're not. These loan types solve completely different problems, and choosing the wrong one can destroy your deal faster than a bad contractor. Today, in 4 minutes, you'll learn the real differences, what each loan is for, when to use it, and how to avoid picking the wrong tool for your strategy. Let's get straight to it. Hard money loans, the fast, risk-tolerant option. Hard money is the go-to financing for flips, heavy rehab projects, distressed properties, or anything a traditional lender won't touch. Here's what makes hard money unique: speed, approvals in days. Asset-based, property condition matters more than your income, higher rates, because lenders take more risk, short terms, 6 to 18 months, typically. Hard money works best when you're buying low, renovating fast, and selling or refinancing quickly. If the property needs work, if the seller wants fast closing, or if the deal can't qualify for bank financing, hard money is your weapon. DSCR Loans, the scalable rental portfolio option. DSCR stands for Debt Service Coverage Ratio, which simply means, does the rent cover the mortgage? DSCR loans are designed for rental investors, especially those who are self-employed, have complex tax returns, or want to scale without personal income verification. Key features of DSCR loans: no tax returns or W-2s, qualification based on property performance, ideal for long-term rentals and BRRRR refinances, 30-year terms available, competitive rates if DSCR is strong. If the property cash flows, you qualify. If the rent doesn't support the payment, you don't. Use DSCR when you want to build a rental portfolio without being handcuffed by personal DTI ratios. Bridge loans, the temporary capital gap solution. A bridge loan does exactly what the name implies. It bridges a gap between where you are and where you need to be. Think of it as a short-term loan used to transition a property from one phase to another. Bridge loan characteristics: medium speed approvals, flexible underwriting, higher leverage than banks, not as expensive as hard money, but not cheap. Terms from 6 to 36 months. Bridge loans are perfect for acquiring properties that need stabilization, waiting for tenants to move out, completing light improvements, holding while refinancing or selling, buying before selling another property. If a deal isn't distressed enough for hard money but not stable enough for DSCR or bank financing, bridge financing fills the gap. So, how do you choose the right one? Here's the simple decision framework. Use hard money when the property needs moderate or heavy rehab, you're flipping or BRRRR ring, you need to close fast, traditional financing won't approve the condition. Use DSCR when the property already cash flows, you're keeping it as a long-term rental, you want 30-year fixed financing, your personal income is complicated. Use bridge loans when the property needs stabilization, you need temporary funding before a refinance, you're repositioning a deal, you're waiting on permits, tenants, or improvements. Each loan type has a purpose. The biggest mistake investors make is trying to force a DSCR loan onto a flip, or using hard money for a stabilized rental, or using bridge financing when you really needed a short-term rehab loan. When you match the right loan to the right strategy, you get better terms, faster approvals, and far fewer headaches. Here's the bottom line. Hard money moves fast, DSCR scales portfolios, and bridge loans solve timing problems. Once you understand the differences, you stop guessing and start structuring deals like a professional. Subscribe for more science-backed insights on personality and decision-making. Educational content. Not financial, legal, or lending advice.